Welcome to a quick update on crypto mining, SPACs and LBOs. Nuclear-powered bitcoins. Struggling nuclear power generators and crypto miners are the new best friends. There are significant environmental concerns with high electricity demand for crypto mining activities. Not only do crypto mining activities consume large quantities of electricity, they also require a stable, always-on, power supply source, like coal power plants. Since burning coal in large quantities harms the environment, nuclear power is a good solution to the crypto miners' power supply problems. It has a very low carbon footprint, and unlike wind or solar, it is an always-on source of power. Nuclear power has been going through challenging times, especially in the US. The power they produce is more expensive than wind or solar, or even that produced by burning natural gas. And given the kind of stigma attached to nuclear power, and the higher cost of safety and regulations, they are finding it hard to sell the electricity produced and make profits. Crypto miners buying electricity from nuclear power generation facilities is a match well made, as they can solve each other's problems. Crypto miners can substantially reduce their carbon footprint, while getting access to stable, always-on power supply. Nuclear power plants can get a captive customer, who can consume large quantities of power steadily. So we have the recent example of Talon Energy Corp., a nuclear power generator, entering into a joint venture with Bitcoin mining company TeraWulf Inc. Such tie-ups are also interesting for companies like the startup Oklo Inc., which plans to build small-scale fission power plants that can run on used nuclear fuel. So Oklo went and signed a 20-year supply deal with hardware and hosting firm Compass Mining. SPAC pessimism. There seems to be a monthly feature, where many big newspapers predict the demise of the SPACs. Harvard Business Review pontificated on it in February 2021, Financial Times in July, Bloomberg in August, and Financial Times again in September. The most recent reporting is because some SPACs experienced redemptions. Redemption is when SPAC shareholders take their money out of the SPAC. They may do that if they do not want to invest in the target company, or for myriad other reasons. However, redemptions lead to target companies receiving less money, or deals not going through. There was a huge amount of SPAC activity over the last couple of years. Like all things that go up and come down, SPACs may wane in popularity as well. Maybe because there aren't enough good fund managers, who can guide the SPAC money to the right destination, and at the right value. Or maybe there aren't enough companies, who'll agree to a SPAC deal. Or maybe there aren't enough investors, who are looking to take on the level of risk that SPACs represent. The optimism of recent times pushed SPACs in the limelight. Because a lot of money poured into the stock market, looking to take on more risk in search of return, it has encouraged companies to access that money. This created opportunities for fund managers to match the companies and the risk they represent, with the money and the risk they seek. SPAC optimism. It's only fair that after talking about SPAC demise, we talk about one of the hottest SPAC deals of late. Polestar, an electric vehicle manufacturer from Sweden, is set to receive $800 million from Gore's Guggenheim SPAC, and another $250 million from a private investment. This deal will value the EV maker at $20 billion. Polestar is majority owned by the Chinese automaker Geely, and its cars are made in Chengdu, China. The company, which was launched 4 years ago, counts Leonardo DiCaprio as one of its investors, and is one of the most valuable EV makers to hit the public markets using the SPAC route. The SPAC is backed by the billionaire investor Alec Gores, and the private equity firm, Guggenheim Capital. Gores is among the most prolific and successful SPAC sponsors, having taken companies like Luminar Technologies, United Wholesale Mortgages, and Twinkie maker Hostess Brands, public. LBOs are back. Companies are rushing to do deals. People are anticipating higher capital gains taxes, which is motivating the deal making. No one wants to pay taxes, including large and profitable businesses. The other reason is something referred to as easy money. For corporations, that means banks and financiers are ready to lend money at attractive rates to do deals. Banks may do that because they have an easier access to money to lend to people. The net effect is that deals done using borrowed money, also known as leveraged buyouts, have gone up significantly. The Wall Street Journal reports that companies have borrowed $124 billion in the first 9 months of 2021, which is the highest since 2007. And of course, all this translates into huge paydays for Wall Street bankers and lawyers. So that's it for this video. A like would be much appreciated. Also, please consider subscribing as that helps out the channel a lot. Thank you, and I'll see you in the next one.